There are, of course, many opportunities to make investments in the market. If you are looking for income and you're looking for consistency and you're looking for track record as well as powerful diversification, I believe that there is a little known class of investments that you should possibly be looking at. And this is closed-end funds, or CEFs. Many people have not heard of these types of regulated investment companies, but they do have a very long 100-ish year history, with some of the stalwarts in the industry having been around since the 1930s. Now, of course, most of the CEFs are more recent, but they do make some fantastic investments. They do have some interesting nuances that many investors find a little bit confusing, and we will go over some of those key elements in this video. Now, of course, as well as that, I will also be discussing the 3 major key points that you will need to be careful of if you want to make these investments. Now, stick with me to the end, because I'm also going to let you know 3 fantastic opportunities that I am looking at in the month of April 2024. Now, these are opportunities where I think there's some good, strong capital appreciation possible, as well as the ability to lock in some powerful income now and going forward. So stick with me to the end and find out what I'm looking at for the family's investment portfolio this month. Let's get into it. Now, one of the most important and possibly somewhat confusing elements of a closed-end fund is the way in which it is closed. Now, what this means is that there's a set number of units or shares of that investment. So say, for example, they had $100 million of investments coming into that company, and they had 100 million shares at $1 each. Now, what that means is the number of shares will not change. There are some nuances there. They can do what they call a rights offering, but in a general principle, it's not going to change on a daily basis. It's going to be a fixed number of shares. Now, because of course we operate in a free-flowing marketplace, the price of items can go up and they can go down. Now, of course, natural, normal market exuberance. At times the prices will be higher as investors surge into this investment. As they bid up the prices, the price can get disconnected. Why might that happen? Well, in some cases, there's a very strong management team there, where investors believe that this management team will be able to unlock long-term value, and so they pile on and they pay more for each of these units in this investment company, more than the actual underlying investment is worth. So, for example, even if the share might be worth $1 or one share would hold $1 worth of assets, you may find investors could bid more than that, and they might be prepared to pay $1.05 or $1.20, or in some extreme cases even $1.30 for that one share of assets worth only $1 on the open marketplace. And so this is an interesting element, and it works in reverse as well. So sometimes these funds will trade at a discount, and so the prices for whatever reason are lower than the underlying holdings of the fund. Nice. Now that means that we get the opportunity to buy, say, $1 worth of investments at perhaps 80 cents. So this gives us some immediate and fantastic advantages, because there's a very high probability that gap will close, and that the investments that we bought for 80 cents on the dollar will over time rise up in terms of the market price, not the underlying value of the asset, but the market price will rise up to that $1 point. And at that point, we have made a capital gain, and at the same time, there's also a nice flow of income. Now, many of these closed-end funds also operate on a monthly distribution basis. And I've got to say, mathematically, there's actually a surprisingly small difference between a monthly distribution and that quarterly distribution that we see with many US-based companies. But the monthly distribution, it just feels good. I like to have that money coming in. There's something beautiful, fantastic, and reassuring about getting those monthly dividends hitting my account, being able to wake up, check the account, and just go, yeah, that just feels good. Mathematically, not too much difference. So from an investment standpoint, it doesn't make too much difference, but psychologically, emotionally, that feeling of stability and security and serenity, I love it. So why are more people not investing in closed-end funds? They are potentially hazardous. They do have the ability to take on leverage in a way that many other investments did not have the opportunity until recently. So you would often find an ETF, for example, with a 10, 20 or even a 30% amount of leverage. So in other words, they buy, for example, $130 million of assets, even though the underlying investments that they have from the investors is only $100 million. And that is powerful. It allows them to juice those distributions, but it also means if something goes wrong, if the value of the underlying investments decreases, then the value can decrease even further for the investors because of that use of leverage. It juices those investment dividends and the income that the fund receives, but as prices decline, it can really hurt. Now, with a closed-end fund, as we discussed, if it's trading at a premium, that leverage can work in double time, at double leverage. So you could see when something goes wrong that the prices drop from a premium to normal, and then if you think about that as well, with that decrease in value, prices can go down further, and then of course as well, if you have leverage, they can go down further as well. And then of course, because it's a closed-end fund, the actual market price can then overshoot that decrease in the value of the net asset value of those investments. And so you can actually get this opportunity, or disaster almost, where the prices were high, they were trading at a premium, and when something goes wrong, it can then massively overshoot to the other direction. So there is the opportunity there for some very wild swings. Now, of course, that can also represent an amazing opportunity for a canny investor with a very long-term mindset and a long-term investment horizon to actually look at this opportunity and to then scale into their investment at very opportunistic times. Now, in my mind, one of my favourite things about the closed-end fund universe is the way in which they give me the opportunity to dive into a range of different investments where either I don't normally have access to that type of investments, I don't normally have the expertise to make an investment in that space, or it is just something which would not make sense. So for example, the size of an investment, say at $20 million, would just be too much for me as an individual investor, while I'm also trying to ensure a level of diversification. So these closed-end funds, they can often be focused around fairly specialized parts or segments of the marketplace, getting into some of the darker corners, the lesser known opportunities. Now, this is also very important as well, because it's a closed-end fund, they don't need to worry about liquidating assets on a regular basis to cash out investors, as we see with an open-ended ETF or exchange traded fund. What this means is, say for example, again, $100 million invested in this company, they don't have to liquidate, they don't have to redeem shares on a regular basis. That fund is there. Now what that means is it gives the fund managers a great deal of stability. It means that they are, for instance, able to take that money and then opportunistically invest with a very long-term perspective, looking to make some long-term gains. So for example, with closed-end funds, we will sometimes see private placements, private investments, where if you think about venture capital, it's that type of company. They've got the ability to take that money, put it to places where I couldn't normally invest directly, and make that long-term investment, knowing that they don't have to worry about cashing out at any time, being forced by markets or investors to cash out. They can hold that investment. They can keep that investment secure for the long term, and that's powerful. That gives them some huge advantages that other investment platforms don't have, that other investment vehicles cannot capture in the same way. And that's one of the things I like about those closed-end funds. Now, it also gives you the ability to access different types of investments, as I said. And obviously, there's some closed-end funds that deal with stocks, and yes, I do have some of those investments. There's also some that deal with fixed income or bonds, and yes, I've got some of those as well. But if you look more broadly, there's also specialized closed-end funds that work in other areas, such as preferred shares and stocks. Yes, I got some of those as well, both individual preferred stocks as well as the funds. And when you begin to think about this, those are sort of normal types of investments that many retail investors will probably be aware of and will probably be able to make. So if we push those aside, for example, there's also other investments, such as, for example, convertibles, such as, for example, emerging markets, such as high yield investments, municipal bonds. There's a whole load collateralized loan obligations, or CLOs. So there's a whole load of really interesting specialized areas that a closed-end fund can get involved in. And these can give the opportunity to investors to actually massively diversify their holdings. Now, the flip side of this is it also means that we need to be more aware of what these fund managers are doing. We also need to be more aware that we don't know too much about that area and that we're actually putting a lot of trust into the fund manager to manage those investments in a very professional way to actually enable us to benefit in the long term.